Also this week, we've seen more curve flattening after the Fed raised rates again last week. If you look back to right before the Fed raised rates in December through today, you'll see a steady decline in the spread between the 2-year and the 10-year, which means a flatter yield curve. So if you look at the yield curve in December and look at it now, the 2-year yield has gone up about 20 basis points, while the 10-year yield has come down about 30 basis points. So the difference between the two has come in about 50 basis points overall. That's like 0.5%. You're not getting paid that much more to hold money longer with the government as you are to hold it for a short period of time, which is fine as long as you're not worried about inflation, which the market doesn't seem to be. But if you're my dad, and no matter what the yield curve is doing, your big investment question for me is always, how do I know that I'll be able to buy the same number of hamburgers in 20 years that I can buy today? Then Bill Irving from Fidelity Investments, their bond portfolio manager, has a good tip for you. Tips right now are undervalued. They have been underperforming for the last few months, so it's a good time to get in them. Irving also points out that corporate spreads and high yield spreads have come down quite a bit, and the implied volatility on corporate bonds and high yield bonds is very low. So everything's looking really good there, which means it might be a reason to reduce a little bit of exposure in corporate and high yield bonds.